Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Have you ever thought of wealth as an elevator? If you haven't, you're about to get the connotation, because my guest, Lane Kawaoka, is the founder of the Wealth Elevator, and we're talking about a financial system and a way of looking at it, and he focuses specifically on first-gen millionaires. I really like this show. I think it's going to give you a wide scope on how he went from starting as a real estate investor to now going much bigger and helping a lot of people with bigger options who don't have the time themselves to do it. Let's go. This is episode 157 of Zen and the Art of Real Estate Investing with my guest, Lane Kawaoka. Lane is the author and CEO of the Wealth Elevator. The Wealth Elevator focuses on real estate syndications, accredited investor banking, and tax strategies for first-gen millionaires. And Lane wants to be the person to take these people from the investment floors all the way up to financial freedom. Lane, welcome to the show.
Hey, thanks for having me, Jonathan. Aloha, everybody.
Yeah, very excited to have you. And you've actually been through a ton of asset classes. So let's start all the way at the beginning. When was the first time that you remember real estate being in your forefront of your mind to be something that eventually could create this generational wealth that you're helping others do now as well?
Yeah, 2009, bought my first house to live in, eventually turned it into a rental. This was when I was in my early 20s, was as a working engineer, construction manager. I was working on the road all the time, and I was owning a home on Saturdays. So I just decided to rent it out. Knew nothing about rent to value ratio or just hired a property management. But hey, that's how it all started. And I got addicted to this stuff back then.
Yeah. When you bought that first property, though, I like to ask this because I think there's so many of us who didn't think like that. Did you think of yourself as a real estate investor at that time?
No, I mean, I come from a very money prudent family, right? We weren't broke, that's for sure, but we weren't super wealthy. My parents always said, "Oh, you never want to have a rental property. The tenants will just mess up your property, right? Your home is your pride and joy." Yeah. And that was kind of what my operating system was. Go to school, study hard, invest in the 401k stuff, have 2.1 kids, and buy a house to live in, right? And pay it down the mortgage.
Yeah. Before you transitioned that property to a rental, were you thinking about it like, hey, maybe real estate could be an avenue to something different? Or was it just kind of you're never home, so why not get some money for it?
Yeah. I mean, before that, it was just the status quo of the FIRE movement, right? I was watching, back then they didn't have FIRE blogs or the Financial Independence, Retirement Extreme, but they had these blog spheres that I would just devour all this content. And, I did a lot of the early credit card hacking where you could get I think I got $50,000, $100,000 of credit card, about 0% balance transfer. And back then you had these rewards checking accounts giving you 6%. So that was what I did before I really started to play with FIRE with this real estate stuff. But it wasn't until I got that tenant in there and I was like, wow, I'm making a few $100 every single month of beer money. And I was like, wait a minute. And it didn't take me very long, maybe 3-4 months. And I was like, wait a minute. If I just did this a few more times, I'll be able to quit my job and fire my boss. And, at the time I didn't really like my engineering job. I mean, who does when you're the new guy, right? So there was that motivation there.
Well, it seems like if you're reading the FIRE blogs at that age, you were always thinking, independence from 9 to 5. And then I guess when that first money clicked, it really started to change. what did you do with that first property? And then how did you start transitioning to more? And then we'll get into the other asset classes.
Yeah, I mean, I didn't do any much with that property. I mean, that property for most standards is like a Class A property in Seattle, Washington. So, rent to value ratios and, it's not the way you want to go, right? Because you have more high-end tenants. But I quickly learned that. And then I just bought a duplex in a little bit rougher area of Seattle. I think 2-3 years later, finally saved up 70, 80 grand to buy that. And took me to about 2012. I was like, all right, I got more money saved up. Back then I was able to save like 50, 100 grand every single year from my paycheck.
Yeah.
So I was moving along at a pretty good clip there. And 2012, if people recall, like prices were starting to skyrocket in Seattle and across the country, bouncing off the bottom, which actually we're kind of in that same predicament right now in 2024. But at that time, I was like, I'm not cash flowing on this stuff, right? Because like the stuff that I would buy in Seattle, like the prices went up 20, 30% pretty quickly. And that was where I got into these out of state turnkey rentals, so I started buying these turnkey rentals in Birmingham, Atlanta, Indianapolis. So eventually had 11 of those in 2015. And that was kind of the point where I'm like, whoa, this stuff sucks, right? Like, I mean, a few $100s of cash flow a piece. I mean, not bad. I'm not going to complain, right? With 11 rentals, that was maybe a few $1,000s of passive cash flow after all expenses every month. So it's almost like I had a third paycheck to myself.
What was your biggest gripe with them? Because I always think, if I think of someone tells me, hey, I have 11 Midwestern rentals, they're turnkey, 100 to 200 a door. I think, well, what happens if one furnace breaks? Just one property can have need a new roof and you're killing your cash flow for half the year on across all of them.
Yeah.
What was your main gripe? Or, what did you like about those? And then what did you not like about having that out of state turnkey option?
Well, I mean, we had property management on all of them, right? But still it became a chore to keep them accountable. And the commercial property managers are so much better accountable than the residential guys in that world.
Yeah.
But like with 11 rentals, I had maybe an eviction or two every quarter. And 1 out of 3 of those evictions always seemed to be like somebody's stuff got thrown out on the streets and it was like 10, 20 grand of repairs because the tenant just trashed it. And then you think to yourself, oh my goodness, $20,000 repair bill because they trashed the property. That's like all my profit for like 3 of these houses for the entire year.
Yeah, that's what I meant. I think that some people like the idea and the sound of that out of state, but they also forget that being a landlord, even with property management, as you said, you still have to manage the manager. And then if there's an eviction, that it's not like you can't be that separated because then someone's mad. No one wants to get evicted, even if they're not paying. They can just put rocks down the toilet or do damage, as you said.
Yeah. And at that time I think in my early 30s, and my net worth was getting to be accredited investor status. And that's kind of where liability comes more into play, right? Like when you're under $500,000 net worth, you're really not a target to be sued. Let's be honest. I mean, you're broke.
Yeah, they will certainly not like for big pockets. Yeah.
I mean, and that's kind of where that started to become more of a forefront for me. And I started to interact with other purely passive accredited investors at that point on. And that was kind of where I found a lot of these investors that used to own rental properties just like myself. And they were moving to the world of syndications and private placements and private equity, venture capital, that world. And I'm like, to me, I always like the golden rule is always you never take financial advice from people who aren't financially free or on the path to where you want to be. And a lot of times that includes, why would you want to listen to a certified financial planner or CPA? Like they're just guys plugging away, working the job. And this is where I luckily found a lot of cool people who were in their 50s and 60s that were certainly triple my net worth. But I'm like, I got to follow what these guys are doing. And if these guys are selling off their single family homes, maybe I need to pay attention to this.
Yeah, that makes sense. And I think like it scales a little bit more with age in terms of like what you want your involvement to be. It's kind of flashy and fun to say, hey, I have 11 of these, but then you realize quickly, well, these are annoying. I don't particularly enjoy being a landlord. I don't know about you. That's what's attractive about syndications for me. Even being an LP now, it's like if I'm trusting the operator, I'm just buying into something that I've already vetted and watching it produce. Is that something that you started to think about as you were thinking about maybe, getting rid of those properties and looking into more syndications or, quote, more passive deals?
Yeah, I think you hit it right on the head there. But that said, you listen to a lot of podcasts and content out there. Very rarely, like the audience target is, generally pointed towards the younger guy, the guy who has way too much time on his hands, certainly doesn't make more than six figures at their professional career, right?
Yeah.
And that was kind of where, like, when I wrote the new book, The Wealth Elevator, like, there was never a book written for, people who already were accredited investors. And most of the books out there are written for lower net worth guys who don't even make 50 grand. And like the Susie Ormans and the Dave Ramsey, I actually met Dave Ramsey. I mean, I like the guy, I like the content, but
Yeah.
that content is specifically made for people in debt, don't have, incomes higher than $50,000, $100,000. And I get it. That's the advice that you need for most people. But what do you do with the people who are very financially conscientious, right? I mean, I had a Roth IRA when I was in my teenage years. What do you do when you're already a accredited investor, right? There's a different dichotomy and paradigm here. And that was kind of what I thought was kind of the underserved market out there.
Yeah, I think that's a great point. And I think you can see that across sites and social media, that it's really focused on that kind of Hail Mary type mentality. Like, hey, you want to change your life. It's like watching an episode of Dr. Phil, like you're going to click one button or take this guru class. And then all of a sudden, all of your problems are going to be solved. And you're right. That is it, because the people in that middle area who have very steady incomes, but those people are suffering because they don't really know what to do. They don't have enough time to go get short-term, like try to do short-term rentals or get some turnkey, or then maybe they get too many turnkey, like you said. So how did you start to focus on that area? And I guess that was attractive to you because that's where you wanted to go as well.
Yeah. I mean, I got lucky because, I started so early. Most of my clients today are in their late 40s, 50s, and their kids. I call these like the forgotten years. I mean, I'm personally in it right now. I've got like a 3-year-old and almost 40, but like, there's a big like lost gap out there where if you have young kids, as soon as your kids are born, basically till when they're like 11 or 12, you don't come up for air. Plus, most people are doing things the traditional investment way, where they're investing in traditional investments. They don't get the tax benefits that real estate does. And their net worth doesn't get to something substantial, $1 million, $1.5 million, until mid 40s. Even if they are good savers at that point. But I would, that it's the two things, right? I would always say it's like, I see it right now being a young dad. It's like, at this point, you just need to go for what's certain, and you don't have the bandwidth to learn anything. And a part of like this real estate investing thing is in meeting other passive investors along the journey. And, because a lot of this stuff isn't on forums and blogs and podcasts out there. It's met face to face with high quality people.
Yeah, it makes sense. I mean, just as you're scaling up in business, then you have 1 kid, 2 kids, like kids cost a lot of money, and that doesn't stop.
Yeah.
That's just kind of the way that it goes. Mine are 22 and 20, and I've been through the gauntlet. And I do remember those years thinking like, how can I add something else on? It's either there's just too much to do, and it's just fun being with your kids also.
Yeah, it is. Like, yeah.
It's hard to think of. I think a lot of people are reframing it sometimes in positive ways, sometimes negative, in terms of doing real estate for their kids. And I was someone who, my dad involved me in real estate from like the time I was like literally a baby. So I was doing property stuff before I even knew what I was doing. But I can see it going both ways now. Are you finding that the people who are interested in the wealth elevator want to leave something for their kids? So they're thinking not only do they want income, but they're also thinking long-term generational wealth that they can then hand down.
Yeah, certainly. I mean, most of the people are family, they got families, they're married, They may or may not have kids, but they definitely are thinking of something bigger than themselves. And oftentimes we have to pull them away from that side and get them to the more. If people have read the book by Bill Perkins, had on my podcast recently, really cool guy. It's the whole idea of like dying with zero, right? Of course, you want to leave $1 million to each of your kids, but anything more, I think, is excess, right? You're just going to create a trust fund kid who's spoiled and just going to do nothing with their life, in excess of $2 million per kid. And that's kind of where like a lot of our folks are very selfless people. And we have to tell them like, look, man, go spend this money right now. Stop working. Just retire in your 50s, I mean, but then again, if you find something you enjoy and you love and you've in a position of high leverage, then by all means. But the whole point we do this is to give us options, and the option is to do something, whatever you want with your time.
Yeah, and I think it helps to get that started while you're still working that regular 9 to 5, because sometimes you finish that and then you're trying to go all in on something, but it's not the right time, or you've already exhausted that time of your life where you have the energy to go, buy a 32 unit apartment and manage it yourself. I don't know why that would sound attractive to anybody, but some people may think, hey, my 9 to 5 just, stopped. So let me try that.
I mean, apparently it resonates with some people. I mean, I can't tell you if I have to hear to another podcast title that says like, go from 1 unit to 1,400 in 3 years. I'm gonna go crazy. Sounds terrible to me. But I mean, look, I think the people consuming this content or is attracted to that, also attracted to very cartoony YouTube thumbnails out there, are the younger folks, and they're hungry, and I think that's great. But I always say like, I tell my folks, like, I call this the concept of like, at some point your time becomes more valuable than money. And for some people, it takes something in their life to really, death in the family, something health scare, for them to really realize that. But if most people, that doesn't necessarily happen. So this kind of like free fall or smooth transition from, in my 20s, I was doing so many dumb things to save money, right? Like so many, like I would have these rewards checking accounts and I'd like go and pump gas for 20 cents at a time for 12 times.
Oh yeah.
On like,
you were really doing it. Like, no matter what it said to get the extras. I was
single too. I had a lot of time on my hands. So like, but somewhere in my 30s, certainly now with younger kids, like you said, right? It's a lot of fun to hang out with them. Time is way more valuable. And especially it can change for people. Sometimes they get it when their net worth goes over $500,000. Most people don't get it until it goes over $1.5 million, right? And part of that, then they're in their late 40s at that point for most people. But this is kind of where I just think that it would be nice if it wasn't a abrupt transition and you're somewhat able to like, you're still saving, you're still, trading time for your money. You're still going to Costco to save $20 on cheaper gas there, right? Even though it's a waste of your time.
You need a 3-pound box of cereal.
Yeah,
I mean,
you need to pick that up too. And there's this kind of transitionary period where it just doesn't go to like, oh my goodness, like our parents' age at this point. A lot of them may have like $2-3 million and they're too old to travel. They physically can't go to Japan or like travel on the public transportation. And it's just the time certain. That's what my big takeaway of that book was like, if you break up your life in 5-year chunks, certain things have gone out the window. I likely will never go to Electric Daisy Carnival or all those dance concert things anymore. That part of my life has gone. You missed the window. The window's gone. That window's gone for me.
Yeah. Oh, I like what you said, though. I mean, because what you're talking about, it definitely works with your book and the title and the company, too, because an elevator moves slowly up the rungs. I mean, you can go all the way to the top, but it's not a rocket ship. And I think a lot of people are looking for the rocket ship. You were saying before that people are hungry, but I feel like these new people are hungry and then a little bit desperate. And that combination of being hungry and desperate leads to them following gurus. Doesn't matter what they say. Like they think what was said on TikTok is real. And then you're like, no, that person doesn't even own any properties. And that's where I think it's hard for this younger generation to really know, like, who's actually giving real investor advice? Who can I trust? And what should I do with my money? when it's only $20,000 or something, not even $1 million.
Yeah, that's it. I like it though. If it gets people into the culture of finances, I'm all for that. Not everybody is going to be a teenager like me and read Kiplinger's and Money Magazine. When I'm on the toilet, like that's the kind of stuff I did. But hey, if it's a TikTok video on like saving money when you're switching cancellation fees on your airlines, I'm okay with that.
Those are helpful. Yeah, and that's a very good point. I do think that the content in general is helpful, and it's not you have to be a consumer of it and try to figure the stuff out for yourself. If someone sells you on a guru program and you buy it, that's on you. You have to do the due diligence along the way. But yeah, I remember I was very fortunate because my dad was always talking about wealth generation and money. But for most people, they don't hear anything. They don't learn anything in school about like any type of alternative finance other than like you get paid for a job. And then they go out in the world and they make money and they pay their taxes, but they're not really thinking, hey, what's going to happen later? The paycheck to paycheck mentality hopefully stops. But then a lot of people now, they would earn more, spend more. And then if you do that and have kids, then you're in trouble.
Yeah, but that's what most people do, right? I mean,
yeah.
But yeah, I mean, like what I set up in like the wealth elevators, there's different floors to the wealth elevator. Obviously, there's like the basement level, the get out of debt. We don't really, I mean, I have a brief chapter about that, but, I mean, I focus more on like where I started, right? The first floor, which is you're under $1 million net worth, you're trying to buy some rentals, and then you're moving up to the second floor of the wealth elevator. I think that's most of the people within our ecosystem. You've got $1 million, $2 million net worth. You're trying to get into real estate. Rental properties are just too much of a pain, high liability. How can you vet out good operators and sponsors and find out good deals and piece together this portfolio of alternative assets? And then, what comes next, right? The third floor and then the penthouse and this is kind of where I was never really a trust fund kid, right? Like I have to figure this out stuff on my own, right? And that's kind of where most of our folks are first generation multimillionaires, right? We don't have somebody's, I mean, I think you mentioned, right? Like your parents did this, but it was sort of like pieced together on their own, right? Like it wasn't.
My dad came from nothing. He figured it out. He figured it out by himself. I mean, he was probably like, I don't know, he was before Carlton Sheets, but he was probably listening to tapes or reading the newspaper, trying to figure out how to do real estate, on the side. And he did. But yeah, I think you're right. I think a lot of first gen millionaires also come with the pressure from their parents who are saying like, hey, do it the slow and steady way, stick with your job, be a doctor, be a dentist, hoard the money. And then at the end, what are you going to do with it? So I think this is important to know that there's floors and the availability to actually use the money to make more money, which makes income. What was the first syndication that you invested in, or how did you realize like this is the thing that you wanted to start betting? Because I think that is hard transition for people who, are used to just looking at properties and now you need to look at operators.
Yeah, I mean, what's hard when you're first starting out is like the operators that you have access to are just the ones that are good at marketing and are starting out. Yeah. So I knew that, and I knew they are all like, fake it to make it people. And, just straight up to be transparent, my first 15 deals I invested in, like a few of them, so 1 out of 5 were kind of landmines, to be honest. But hey, I didn't have any accredited investors around me. I was just doing this myself. And unfortunately, the reality for passive investors, you don't really know other accredited investors doing this stuff either.
Yeah.
And you're going to have to step on the same landmines here. But the idea is go into a few deals, get some street cred so that you can interact with other purely passive and accredited investors, meet friends and stay close to them, and then avoid the landmines together. But the way I did it initially, I mean, I'm a numbers guy. I can use a spreadsheet, right? So you take the P&Ls, you take the rent rolls. I can figure out what that property is worth. I can sort of, deduct what the rent comps are, even without Yardi or CoStar. And I can figure out, is this business plan to bump the rents from $750 up to $900 legit, right? And from there, I can plug it into my analyzer and kind of come to the same number or, come to the same number in a different way and verify if this deal is legit. This is something I kind of, I teach a lot of my folks to vet deals, not from like a purely underwriting standpoint, because I think this definitely goes beyond the scope of most passive investors. Most passive investors, I'll give you an analogy, like cars. I don't know anything about cars, right? I might be an engineer. I don't know anything about it. So I'm going to buy a used car. Well, actually, that's why I buy new cars, because I don't want to be like cheated. But if I were to buy a used car, I would take them to mechanic, or I would like have my buddy who does know cars. I'm going to ask him, hey, tell me 3 things I should spot check, just so, the 80-20 rule, right? So in real estate syndication, in my opinion, the biggest 3 things to check is what is the reversion cap rate and the difference between that and the prevailing cap rate today? What is the assumed occupancy in the deal? May not be the most biggest lever, but it's one of the easiest things I think past investors can look through a pitch deck and spot out. And the last one is like, what are the rent escalators? Like, what is the assumption that the rents go up every single year? So for the reversion cap rate, right there, you want to assume that you're going to sell in a weaker market in the future. So it makes sense for the reversion cap rate to be slightly a quarter point, half a point higher than the prevailing cap rate than it is today. The occupancy, that thing isn't going to run at 95% occupancy. It's going to usually be about 92%. And then you add on a few percent points for economic vacancy in there too, right? If you see a pitch deck that's showing you 96% occupancy, that's just too high. That ain't going to happen. That's wishful thinking. And if you see a deal that's anything higher than 3% rent increases per year, maybe scratch your head a little bit, right? None of these are disqualifiers, but I think it's good starting points. And that's where when I first started to invest, these were the things that I spot checked out first, right? Before I ran into my analyzer and kind of did do full due diligence. But I think, again, I don't want to this passive investor thing should be relatively easy. You're not going to be underwriting specialists, right? Family, and then the funny thing is, as I start to meet these family offices on the penthouse level, the wealth elevator and higher, what they do is they outsource this stuff. They pay consultants to do their due diligence for them.
Yeah.
They know how to speak the lingo, but
in all short in self-storage transaction, there's always a consultant who's running all of the data for the demographics that make the deal make sense. That makes sense completely. And I think that people are looking, again, that's the avatar of who you're looking for also. Someone who doesn't want to do all the due diligence and doesn't want to learn how to completely underwrite, because that's another job.
And they're too cheap to go hire a guy for $1,000, couple $1,000, right?
Yeah.
But those are the suckers that need it the most, right? That's where I was initially
if we
30s.
Go back to those 15, the landmines ones, I think this might help some of the listeners who maybe are dabbling in syndication. What was the thing that made those the landmines? Was it in the due diligence, or was it something about the operator, or a combination?
I mean, I would say most of those were just the operator kind of just went AWOL and just wasn't proven. Yeah. So it's in the analogy, people use this analogy of the horse and the jockey, right? Where the horse is the deal. You can underwrite the deal, you can see the P&Ls, and the horse or the jockey is the operator, right? In multifamily real estate, in reality, in the grand scheme of things, the horse is really all you need. As long as your jockey doesn't steal money and is not a complete imbecile, things will be all right. Which is the complete opposite when we're starting to invest in venture capital deals and actually put together VC deals there on that side. It's completely switched.
Yeah, that makes sense.
Yeah, the operator is so much more important, and you can have a really dumb idea, business plan, but if a good operator has done it before, it's kind of swapped in that world. So that's kind of where, in a way, venture capital is very asymmetric, and it's so hard. And if people tell you they have a system, that's BS. They're just full of themselves. But in multifamily real estate, from an investor point of view, it is a little bit more quantitative, I guess, right? What is the occupancy? What are the current rents, income, expenses? But from vetting the operator side, which is less of an importance, it's more important that they're just not a criminal and, they follow plans, but they don't need to be a genius, right? I mean, that's why we all come to real estate initially. You don't need to be a genius to do this. It's a time-tested business plan. Sure, things could get disrupted, industrial properties. Amazon could just start shipping stuff around without using the warehouses, for all we know. But for the most part, real estate is sort of been in steady state for many, many years and will likely be in high demand and steady state in terms of demand for many, many years to come. And yeah, there'll be some cool innovations that happen like AI, rent fluctuation, dynamic pricing, or, the Amazon storage lockers, or cool things to charge people on. Let's charge them for trash valet because everybody's so lazy. But for the most part, I mean, it's not a, game changing, revolutionary type of business.
Yeah, I would agree with that. I mean, underlying real estate as a whole, as a purchase, is land. So first you have the land, then you have an existing building. So even when things go haywire, you still have a tangible asset right in front of you with another tangible asset underneath it. So there's still options for that. It can be repurposed. I mean, if you look at the large scale office buildings now, that's what's in trouble. It's just about what they can be repurposed into, and residential's hard for that. But you still have this giant amount of square footage to do something with. Someone can come up with an idea.
I'll provide, just so we don't regurgitate stuff on other people, the gazillions of other podcasts out there. I mean, look, I'm a fanboy of real estate. Don't get me wrong, right? Got to me where I'm at. But the problem with real estate is your returns aren't as massive. So like a lot of these business plans where you're trying to, bump the rents up 10, couple $100, right? Buy new flooring, new appliances. It's a great business plan. Don't get me wrong. Great business plan. But all you're trying to do in a nutshell in several years is to bump the NOI by 10 to 20%. And that's enough to double your money in 5 years.
Right. Yeah. You want to raise the valuation overall of the whole property. But yeah, I mean, I guess it depends why people want to get in. I don't think syndications are for the quick buck. Even if you think it's a 3-year turn, you may have to wait it out. It's market dependent.
But what I was saying is, like, when the market goes down 30%, like how we've seen it in 2021 to 2023, you're SOL, you're underwater, right? Even if you did everything you're supposed to on that business plan. And this is where sometimes, developments, have a much higher bump in terms of value. And when you bump it that much, depending on where you are in the timeline, if a correction were to happen in the worst time, you might be still all right. Or venture capital deals or private equity buying up businesses, right? Your bump is so much more higher. High risk, don't get me wrong. But in a way, like that ability, if something were to happen in the economy, which is kind of outside your control, it's still there. So I think this is kind of where I've made maybe the mistake prior to, or my first 10, 15 years of investing. I was very much into real estate. 90%, maybe even 100% of my net worth was into real estate. But maybe I needed to diversify. No, I'm not saying I'm going away from real estate, right? But maybe 10, 20% in venture capital deals, another 10% in life insurance, another 10% in private equity, core 50%, 60% in real estate, sure. But to diversify over these different asset classes.
Yeah, I think that's smart. And I mean, I think you can be diversified within real estate. There's so many different types of asset classes, but it's still real estate. I like all investing. I mean, most investors do. It's just about, do you have the capital to make things happen? But I think that's a wise choice. I mean, I've always liked stocks. I find them boring and not tangible, but they make money.
Yeah.
If you have enough money to let it sit around, it's going to make money. But you do with real estate, it's just about patience and waiting. I think that if people are more patient and they can focus on that, then they can wait. I mean, when you go in as an LP for your first syndication, and then you think, hey, you look at the numbers and you're like, wow, these numbers look great. And then you get the first check, and it's like $500. You're like, I mean, depending on how much you put in, if you put in less than $100,000, those checks are going to be pretty small because you're forgetting that there's going to be a turn at some point for a sale. Have you had to really coach people on what to expect from these type of investments if they've been thinking, about your regular, hey, quick cash flow return?
Yeah, I mean, I think I was personally there at one time too, right? Like when I was still working my day job, the attitude was like, I need cash flow. I don't really need equity growth. I just need cash flow so I can improve my monthly like cash flow burn so I can quit my job. So I don't have to work that job. And I think most people, that's their original goals. I need cash flow. I want it now too, is the second thing. But in reality, as I started to interact with more experienced, higher net worth investors, they could give a damn what happens on the monthly distribution, quarterly distribution.
Exactly.
Only your more newer investors and more skittish ones. And if this is you, I mean, I think we're all safe to say, don't be offended, right? Take this in light. I mean, it was me too.
Yeah, I think everybody who wants to invest is in that spot at one point because it sounds better.
Yeah, I want it now, right?
Yeah.
But you play it off as like, I'm trying to build a monthly cash flow thing so I can, I get it, whatever. I told myself the same BS too. But what I'm saying is what I've learned from higher net worth investors is they take a look at things more on like the bigger time horizon in terms of what's happening, not year after year, but in 2-3 year increments, in 10-year increments, heck, even 50, 100-year increments, right? So I heard this kind of messed up thing that investor said one time, and I get it. It comes from a place of pain because the guy was just beat up the last couple of years. It's been a horrible time to invest in commercial real estate these last couple of years.
Oh, yeah.
But he said, like, I don't like these deals because it's like a boomerang. You throw this boomerang out there and then you got to wait for it to come back. And I was like, wait a minute, dude. Isn't that all of investing? You know, like you got to plant the seed.
Right back to your hand. It just takes a little while.
You got to plant the seed and you got to have patience. If not, go do a T-bill, right? Where you only get, right now it's high at 5%, but normally it's like nothing, right? Like there's a trade-off between liquidity and then having your money out there liquid, the boomerang away, waiting for it to come back and higher returns. I mean, after all, to do a business, anybody who's owned the business knows that you need to invest money, do some stuff with it, have there to be some luck involved and it to come back. I mean, you can't have it all. Like, there's like a Chinese proverb says that Buddha said, you can't ride two horses. You can't have cash flow and equity appreciation, right? You need to have a little bit of both. But then that's where, like, I think investors need to not myopically look at that one deal. And I get it. When you're new, that $100,000 deal, it's your everything. But you need to act more like an accredited investor who should have dozens of these types of holdings at $100,000 a piece and look at it from a portfolio standpoint. Now, this is where maybe a third of your holdings, you want it to be higher returns, and therefore it's going to be illiquid for a long time. And some of it, maybe you want to be in more short-term stuff, maybe even junk bonds, maybe even T-bills. And that's where we like the life insurance, right? That's as liquid and as safe as you can get. And this mix of like short-term, long-term spread in these different asset classes out there too. This is the vernacular that I think investors need to move to. That said, it's unless you get around people that think this way, you're just stuck in the sad American dial of what Vanguard has and their little, index ratios and stuff like that.
Yeah, and again, that can be a small part of what you do also. But I think maybe people don't, again, this goes to your entire theory behind the wealth elevator. People don't think that they think that they have to become an expert in all these areas and then go for it. But that's what the experts in those areas are for. And that's what syndicated deals are for. You don't have to become an expert in multifamily and then become an expert in short-term rental. You can just pick people who are doing it in bulk and ride along with it.
Yeah, exactly. And that way you get out of the being the operator. And you focus more on like your portfolio creation, not what's in what the eggs are in individually, but where you have how you structure your baskets. Like I said, like I think what got me to where I'm at today was concentration, and maybe I got lucky, right? Because I started at the right time and rode a great bull market, and at that point, a big part of a takeaway of the Wealth Elevator book is I call a threshold of endgame. So I define that for most people around $4 to $5 million net worth, because at that point you can cash flow at 5% in a T-bill or life insurance, and you'll be set, right?
Okay,
and end game level, and this changes for different people, right? If you're older, And the sad thing is if you're really old, all you need is $10 for your next beer and then that's it. Right. So this number changes. So people in their, to give more realistic data point, people in their 60s, a older couple with kids who are already financially independent, they may only need $1.5 million net worth. Right. But our folks tend to be a little bit more younger. They still have kids that still need to go to college. That's why we say $4 to $5 million. A lot of folks are in California, so they pay a lot of taxes and they have big houses too. But $4 or $5 million net worth is that threshold. And at that point, and I've kind of seen it for myself, right? Like you get to that threshold and your portfolio changes, right? Maybe you start to put a lot more stuff into life insurance at that point, right? You're kind of hedging yourself. You still want to play things and you still enjoy investing and you like the idea of like, maybe not so much what the returns you're getting, but like just the spirit of investing, right? Putting your money to work and have it do bigger things. And I think that's the spirit behind venture capital. Like you're doing something just revolutionary and it can be very much for the environment or special interest groups, whatever floats your boat there, right? But this is where, these higher risk, higher return or asymmetric type of deals, you can get the same amount of bang for your buck, same amount of bang, but a much smaller buy-in price, right?
Yeah.
Then if initially, like when I invested, the vast majority of my net worth were in real estate, I couldn't get, I was never going to triple my money in 3 years with that stuff. That wasn't in the cards.
That goes to the diversification, though, of looking at assets. And I think that's really how you learn to get to whatever point you want. Maybe you spend 10 years playing around, seeing which ones work, making careful investments, but knowing, the whole great thing about investing is you can trade it if you want to. Most things you can trade it out and sell it. Sometimes it's the market's not great for that and you need to hold it a little longer, but assets move around. You can move something new in, try something new. Hey, it's Jonathan. On this brief interlude, I want to give you an update because our new website has launched. zenandtheartofrealestateInvesting.com is live and you can go there and check it out. I really want you to go check it out because we're going to still be upgrading more, but it's going pretty well so far. This is a very guest-focused podcast website. Each guest has their own profile with their own links to our 10-minute clips on YouTube, and also links to the episode. You can search for guests using the alphabet, or you can search in the search bar. Soon we're going to have tags up as well so that you can search in certain categories: short-term rentals, mid-term rentals, syndicators, multifamily, and then you'll be able to link to the episodes on that. I have really put a lot of time into working with my team to get this website to be extremely visitor-friendly and very guest-friendly. I hope you enjoy it. At zenandtheartofrealestateInvesting.com, let's get back to the show. If you had to go back and look, just in terms of real estate asset classes, what asset class is your favorite to be a part of as an owner?
I always ask the question, and this goes for all businesses too, like what is it that everybody's euphoric about? And what is things that are kind of beat up right now that nobody's talking about is the way I look at it. I think obviously, like we all know, like, office. I don't know about that, right? I don't know. I hear both sides.
If you were optimistic about the future of offices, there's a lot of good deals out there, right? They're everywhere.
Yeah, I do think it's a little bit more nuanced than that. Like I do believe like people are returning and will return back to the office, but they'll need to go to the class A offices. Like a lot of people on my mastermind board that run businesses, they're going back to offices, but they need to entice people to get back to the office, whether that's free beer on Fridays or every day, and a chef. But definitely in there, the package is a really, really nice class A office. Whereas I think the losers will be the B and C office classes. So unfortunately, when most people read the headlines on this stuff, if it's even up to date, even if you're reading the industry and publications, it never really teases out this shift between, or this paradigm between class A and the rest. But I'm not in office, so I don't know. I may invest a little bit in it because I like the whole story of zig when everybody is zagging.
Yeah, same.
But I wouldn't put more than maybe 10% of my real estate holdings in office at this point, personally. But if it was,
Yeah.
it'd be that class A stuff, like the really sexy, nice stuff with cool amenities. But as far as, I think apartments have been absolutely beat up these last couple of years. I think, that's always had the long runway rate. The
Yeah.
issue there was a lot of like short-term bridge notes were pretty much the big part of it these last 4 years. And
Yeah.
it's not like anything was broken in the industry. It's just things got caught with the 40-year high in interest rate, the quickest time in history, kind of
Right.
broke things. So I like that right now. Mobile home parks. Mobile home parks is tough. It's very like in theory, you can invest in worst areas because it's kind of like the bottom tier of tenants. Self-storage, I'm not a huge fan of self-storage because they can just build something pretty quickly and you're automatically competing with Class A. Whereas in the multifamily world, if you have a Class B asset and they build something next door, it doesn't necessarily compete with you directly. And then I saw this other thing the other day where people are like kind of like doing the Uber for self-storage. Like if you've got like a self-storage closet in your backyard, you can rent it out on this app. So I don't know how disruptive that is. But, I think what I'm doing like for my real estate stuff, again, I'm a general partner operator. So I'm always going to be much less diversified than the average passive investor out there, right? I'm going to do my own deals and eat my own cooking. And I'm going to get a lot of my own stuff.
That's important, though, because that helps you attract better limited partners because they know that you have skin in the game. I mean, for a limited partner, one of the biggest things you want to know is how much skin does the operator have in the deal. If they have none, it's probably not going to go very well because they can walk away and have no personal loss in it to themselves.
That depends. If you're working with an institutional operator who has a long-running track record, those guys don't put any skin in the game.
Well, they have a waiting list too. So you're right.
Yeah. But that rule that you're stating works for people under a few $1 billion of assets under ownership there.
Yeah.
But yeah, I would actually, something that we've seen this past several years is maybe you want to invest with the institutional operators out there because you don't want to be investing alongside doctors, dentists, engineers, regular people, because when tough times come, those little average Joes can't write a $50,000 check to save their life for a capital call. Where you want to be, this is what we've been trying to align side family offices, because when things go wrong, they don't like it, but they write a $5 million check and we're off and rolling.
Yeah. Yeah, that makes a lot of sense. So just in terms of the wealth elevator, who's the ideal reader for that? Because I think you do have an avatar that really kind of sets this up really well for them.
Yeah, probably that second floor avatar. So net worth $1 million to $3 million net worth. The whole idea of why you read books is to cut corners and save yourself time. Just like how I tell the people on the first floor, don't go buy 11 rental properties like me, right? If you're under $1 million net worth, maybe buy one or two. But, if you're on the second floor of the wealth elevator, getting involved in syndications and private placements, that's the way to start where you're at. But that's not the operating system moving forward long-term in the future. And if you can get to the next floor and then switch and cut back, that's the way to do it. I guess unfortunately, I climbed Mount Fuji one time. That thing is just screws with your head because you get to one perch and you see two perches ahead of you. You don't see what's after that. So perspective is a big thing. And that's part of what the wealth elevator is. Until you get to the second floor of the wealth elevator, you don't see what's on the third. And if you don't get to the third, you don't see what's on the penthouse. But that's where it's nice to read a freaking book because it makes life easy for you. It kind of is all out there. I'm an engineer, so I got the chart for you guys. Right. It makes it easy.
Well, I think that people should be learning from others' mistakes or else they're bound to make the same mistakes. you can read about it and decide to go down it and maybe think that you know better, but at least you would have had at least an option to say, hey, that was exactly what I'm going to do, and now I'm not going to do it. I don't want 11 Midwest rentals because it doesn't fit the profile of what I want to do in a management sense.
Yeah. I mean, you're at such a disadvantage. I mean, just speaking for myself, right? Like, I didn't know any accredited investors. I didn't have any rich uncles. So even buying rentals was tough. And then getting into this world of private placements and syndications is extremely difficult. And I made a lot of mistakes.
Yeah.
So you've got everything kind of against you. And to me, the way to get over the hump is to align yourself with other purely passive accredited investors. And that's what we have. We do fun events, and, we kind of keep a good vibe, and we kind of, repel people who kind of aren't of the same like collaborative mindset. But I think that's what everybody needs, is like 4 to 5 good guys around you, gals, that also have a net worth of $1 million plus too, is a big qualifier. And that's who you surround your family around with, right? Have them grow up with. You have your pickleball friends, you can have your drinking buddies, you can have your other family friends, but I think you need a tribe of financially minded people on the same trajectory as you with this stuff.
Yeah, I completely agree. I mean, it's a traditional principle of the 5 people that you spend the most time with. That's who you are, but that's who you are with money as well. I mean, that's exactly what you're saying. If you spend time with 5 people who just love to gamble and dumping money, and none of them are financially secure, it's unlikely you're going to be financially secure if that's where you're spending all your time.
Those guys are fun though. Don't get me wrong.
Yeah, right. Those are the drinking buddies.
Yeah.
I mean, you just have to know, like, that's not me. I'm going to cut them out of the top 5.
I'll tell you who are the most boring people. Maybe I shouldn't. No, I'll say it. Like, in my younger days, I would go to the FinCon, like the financial independence for fire extreme people. Man, those are some like the boringest parties there, because everybody's so cheap. They don't,
Yeah, there's no food. It's just,
certainly they think. I mean, essentially illustrates the point of they think money is more valuable than time.
Yeah, you're right. You're right. And I mean, I think that goes to the principle that, okay, if you stop buying Starbucks every day, that doesn't get you rich. It saves you money, but that's not going to earn anything.
Yeah.
There's a big difference, between saving and earning.
Yeah. And this is kind of why we're big on community. At the end of the day, social relationships are the currency of the wealthy. Certainly when you get past a few million net worth, you start to realize that. So it's funny, you go through this transition of, when you're on the first floor of the wealth elevator, you need to be thrifty. Don't buy your latte. Once you get to $1 million, you may have your latte. But after that, it's like, well, have a latte with a friend, right? Yeah. Because at the end of the day, that's all that really matters to you now.
Yeah. No, that's great advice. All right, Lane, is the best place for people to get more info about the Wealth Elevator? It's thewealthelevator.com.
Yeah, I got a podcast, been doing it since 2016, and they can check out the book, The Wealth Elevator, on Amazon, and email address lane@thewealthelevator.com if people want to reach out.
Awesome. And podcast is The Wealth Elevator as well?
Yeah. Them all.
Awesome, man. Well, I really appreciate you spending the time. I'm glad we got this done. And I hope people will check out those links that we drop in the show notes. Find the Wealth Elevator. Thanks so much for spending the time.
Cool. Thanks, Jonathan. Appreciate it.
All right. Okay. That was Lane Kawaoka. I'm Jonathan Green. We'll see you next episode. Hey, it's Jonathan. Thank you so much for listening to the entire episode and getting to this part. And if you're here, you should realize that this is new. I'm starting to do episode previews at the end of every episode so you can hear who's coming up. You can also follow on social, where I post a lot of that on LinkedIn, sometimes on Instagram. You can really find it anywhere. And this is a great way to just know who's coming up next, so you can set it and forget it if you're subscribed to the podcast, which makes sure that you get it every Monday and Thursday morning before you wake up, so you're ready to go and listen the first second you wake up. Next episode, episode 158, my guest is Tony Lopes. He's the founder of Dirty Boots Capital, and there they want to create a life of freedom. And what Tony means by this is active and passive real estate investments, business opportunities, asymmetric plays, and more to develop a plan B that is specific to his client's needs. We go through the whole journey. I've been on Tony's podcast. I'm glad to return the favor now by bringing him on mine. We had a great, fun conversation. I know you're going to enjoy it, so stay tuned for the next episode. Tony Lopes.